Imagine this. It is a Tuesday morning, and you are driving to work. You are already mentally calculating your grocery budget for the week, realizing you have exactly $42 to last you until Friday. Then, it happens. A loud pop, a hiss, and the steering wheel jerks to the left. You pull over. Your tire is blown. You call the mechanic, and the quote is $300. You do not have $300. You do not have a credit card because your credit score took a hit 3 years ago. You cannot ask your family because they are struggling just as much as you are. But if you do not get to work, you lose your shift. If you lose your shift, you cannot make rent. You are cornered. Then you see the sign. It is bright yellow and red, flashing in the window of a strip mall. Fast cash, no credit check, instant approval. It looks like a lifeline. It looks like salvation. But what you are walking into is not a bank. It is a trap designed with mathematical precision to ensure that once you step in, you never truly walk out. This is the world of legalized loan sharking, where the interest rates hit 400% and the law is not there to protect you. The law is the weapon being used against you. Most people think of loan sharks as guys in dark alleys breaking kneecaps. That is the old way. The modern loan shark wears a suit, trades on the stock exchange, and operates out of a storefront that looks just like a legitimate financial institution. They do not break your knees because they do not have to. They break your future instead. The entire business model of the payday loan industry is predicated on failure. If you pay back your loan on time, they actually lose money. They need you to fail. They need you to roll that loan over. They are banking on your desperation. Let's break down exactly how this math works, because it is designed to be confusing on purpose. You borrow $300. They charge you a fee, say $45. They tell you it is just $15 for every 100 you borrow. That sounds reasonable, right? If you borrowed $100 from a friend and bought them lunch as a thank you, that's about $15. But here is the trick. That $45 fee is due in 2 weeks. If you calculate that as an annual percentage rate, or APR, it is not 15%. It is nearly 400%. To put that in perspective, a credit card, even a really bad one, might charge you 25%. A mortgage is around 7%. These lenders are charging 400% interest. And in some states, it goes as high as 600 or 700%. So 2 weeks pass. It is payday. But you are living paycheck to paycheck, remember? That is why you took the loan in the first place. Your paycheck comes in, and the lender immediately withdraws the $300 plus the $45 fee. That is $345 gone from your account instantly. Now, you have a hole in your budget for this month that is $345 deep. You cannot pay your rent and buy food with what is left. So, what do? You go back. You take out another loan to cover the hole the first loan created. You pay another fee. This is called the churn. The Consumer Financial Protection Bureau found that over 80% of payday loans are rolled over or followed by another loan within 14 days. The average borrower ends up taking out 10 loans a year. By the time they are done, they have paid far more in interest fees than they ever borrowed in principal. You might borrow $300, but over the course of a year, you pay back $800, $900, or over $1,000 in fees alone, and you still owe the original $300. It is a debt trap. It is a financial quicksand where the more you struggle to pay, the deeper you sink. But how is this legal? That is the question that should be burning in your mind. How can a business charge 400% interest when usury laws have existed for thousands of years to prevent exactly this kind of exploitation? The answer lies in a systematic dismantling of financial regulations that started in the late 20th century. For a long time, states had usury caps limits on how much interest could be charged. But then came deregulation. Lenders found loopholes. They started operating in states with loose regulations and exporting those rates across the country. When states tried to crack down, the industry evolved. They developed something called the rent-a-bank scheme. This is where a payday lender partners with a small bank in a state with no interest rate caps, like Utah. The bank technically originates the loan, bypassing your state's laws, and then instantly sells the loan back to the payday lender. It is a shell game designed to strip you of your legal protections. They are laundering predatory loans through legitimate banking charters. And let's look at who they target. These storefronts are not distributed equally. You will not find a payday lender on every corner in wealthy suburbs. They are clustered in low-income neighborhoods and communities of color. They set up shop in what are known as banking deserts, areas where traditional banks have closed their branches, leaving residents with no option but the predatory alternative. They market themselves as a solution to an emergency, but their internal documents show they target people who they know cannot pay. They are harvesting the poverty of the working class. This is an industry that drains billions of dollars a year from the pockets of the people who can afford it the least. It is a transfer of wealth from the poor to the rich, facilitated by a legal system that has been bought and paid for. The lobbying power of this industry is immense. They spend millions of dollars every year in Washington and in state capitals to fight against any regulation that would cap their interest rates. They argue that they are providing a necessary service, that without them, people would have nowhere to go. They paint themselves as the heroes of the unbanked. But real heroes do not charge 400% interest. The psychological toll of this cycle is devastating. Imagine the stress of waking up every day knowing that every hour you work is already owned by someone else. The anxiety of the debt collector's call. The shame of not being able to provide. This kind of financial stress destroys health, it destroys marriages, and it drives people into bankruptcy. In fact, borrowers who use payday loans are nearly twice as likely to file for bankruptcy as those in similar financial situations who do not use them. It creates a class of people who are permanently structurally indebted, working essentially as indentured servants to a storefront in a strip mall. And the technology is getting scarier. Now, with online lending, they do not just take a check. They have direct access to your bank account. They can hit your account for payment the second your paycheck lands, before you even have a chance to buy groceries. If the money isn't there, they hit it again and again, triggering overdraft fees from your bank. Now you are getting hit from both sides, the predatory lender and your own bank, both feasting on your lack of funds. We have to stop looking at this as a personal failure of the borrower. The narrative that the industry pushes is that these people are just bad with money. They say, if you didn't want the loan, you shouldn't have signed the contract. But that ignores the reality of poverty. When you are drowning, you do not look at the price of the life preserver. You grab it. The industry knows this. They are exploiting a vulnerability in the human condition, the desperate need to survive the immediate moment, regardless of the future cost. It is predatory by design. It is not a fair exchange of goods and services. It is an act of aggression against the working poor. There are alternatives, but they are suppressed. Postal banking, where the post office provides basic low-interest banking services, could wipe out the payday loan industry overnight. Capping interest rates at 36%, which is what the military has done to protect active duty soldiers from these lenders, would end the predatory model. If it is too dangerous for a soldier to be trapped in this debt, why is it acceptable for a single mother or a struggling student? The fact that we protect our troops from these sharks but leave civilians to be eaten alive tells you everything you need to know. It is not that we cannot solve this. It is that we have chosen not to. We have allowed the pursuit of profit to override the basic moral obligation to protect the vulnerable from exploitation. When you look at the neon sign offering fast cash, do not see a business, see a system that is broken. See a mechanism that converts human struggle into shareholder value. The 400% interest trap is not an accident of the market. It is a policy choice. It is legalized loan sharking, plain and simple. And until we recognize it as such, until we demand that the law protects people rather than profits, the trap will remain open, waiting for the next person to have a flat tire, a broken tooth, or a moment of bad luck. The scariest part is not the interest rate. The scariest part is that it is all perfectly legal. The law hasn't just failed, it has been weaponized. And as long as that sign is flickering in the window, someone, somewhere, is about to lose everything for the price of a temporary fix. This isn't just about money, it is about freedom. And right now, freedom is being sold at 400% APR.